What if I told you there's a $1.7 trillion market that could trigger the next global financial crisis, and most people have never even heard of it? Welcome to private credit, the shadow banking system that's grown larger than Australia's entire economy. It looks calm on the surface, but underneath, there are warning signs that echo 2008. Today I'll explain what private credit actually is, why it's become a ticking time bomb, show the numbers and charts that matter, and lay out how this could blow up and touch everyday people. By the end of this video, you'll see how a market that lives in the dark could make 2008 look like a warm-up act, and what to watch for next. So what exactly is private credit? Imagine you run a mid-sized business that banks won't lend to. Maybe your cash flow is uneven, or you've got a complicated debt profile. Traditionally, you'd issue bonds, go to the stock market, or borrow from a bank. But there's a third option that's exploded: private credit funds. These are pooled investment vehicles run by firms like Apollo, Blackstone, and KKR that lend directly to companies, often at higher rates and with bespoke terms. Private credit comes in many forms: direct loans, unitranche financing, a mix of senior and subordinated debt, mezzanine loans, and specialty finance. Lenders market these as higher yield, lower volatility alternatives to equities, appealing to pension funds, insurers, and wealthy clients chasing income in a low-rate world. The growth has been dramatic. Back in 2010, the private credit market sat around $300 billion. Today it's roughly $1.7 trillion, nearly 6 times larger in just over a decade. Picture a chart rising steeply after 2010 as banks pulled back, regulations tightened, and investors chased yield. Why the surge? Post-2008, traditional banks were constrained by capital rules and risk limits. Private credit funds filled the gap, offering flexible financing to companies banks wouldn't touch, and they did so with far less regulation and disclosure. That combination, scale plus opacity, is where risk accumulates. Who borrows from private credit? Mostly mid-sized companies, the ones too risky for a big bank loan, but too small or complex for public bond markets. They pay high rates, typically 8 to 15%, sometimes higher when risk spikes. Crucially, about 80% of these loans have floating interest rates. That means when central banks lift rates, borrowers' debt servicing costs jump quickly. Now layer on another problem: liquidity mismatch. Private credit funds often promise investors relatively quick redemptions. 30 to 90 days is common in marketing materials, while the loans they hold are long-term, often 5 to 7 years and not easily sold. That's a classic mismatch: short-term promises against long-term illiquid assets. Look at the data. Default rates in private credit have risen from roughly 2% in 2021 to over 6% by 2023 in some vintages. Interest coverage ratios, how many times operating income covers interest expense, for many borrowers are deteriorating, especially in cyclical industries. Imagine a mid-market manufacturing firm with a floating rate loan. Input costs rise, sales slow, rates go up, interest payments balloon. Suddenly, a business that seemed viable is in distress. If enough of those borrowers default, funds face write-downs and evaporation of NAV, net asset value, and that's when redemption pressure builds. This isn't fringe. The biggest asset managers are central players. Apollo Global Management has hundreds of billions in credit strategies. Blackstone runs several hundred billion in private debt. KKR, Carlyle, and others manage large pools too. These firms sell private credit to pension plans, insurers, endowments, and high-net-worth individuals who want steady yields. That mix of long-term institutional money and wealthy retail exposure amplifies stakes. In 2023, warning signs became visible. Several large private credit vehicles started gating withdrawals or severely limiting them. Apollo publicly restricted withdrawals on certain funds to as little as 2% per quarter, citing exceptional market conditions. Blackstone and other managers put similar limits in place or suspended redemptions temporarily. Why? Because when funds face accelerating defaults or falling valuations, they may have to sell assets at fire sale prices to meet redemptions, which destroys value for remaining investors. So managers try to stop the run with gates and notice periods, but those measures signal stress and can spark panic across other funds and institutions. How does contagion happen? If pension funds and insurers can't get their money, they might scramble elsewhere to raise cash, forcing sales in other markets. Banks with exposure to the same borrowers could feel strain. The opacity of covenants, leverage levels, and cross-holdings means risks can jump from private credit into broader credit markets quickly. Where do we stand now? Fundraising for new private credit has slowed, signaling growing investor wariness. Corporate bankruptcies are ticking up in sectors under pressure. Interest coverage ratios, on average, are worse than 2 years ago. Regulators are watching, but private credit remains far less transparent than bank lending. What could trigger a full-blown crisis? A sharp recession that spikes defaults? A rapid, large rise in interest rates that blows out floating rate payments? Or a sudden loss of confidence that causes simultaneous redemption requests? Any of those could turn illiquid loan books into forced sales and fire sales, creating knock-on effects across pension funds, insurers, and even banks. What should everyday people watch? Keep an eye on headlines about large funds gating withdrawals, rising default statistics from credit rating agencies, and increases in corporate bankruptcies. If your superannuation or pension provider is heavily allocated to private credit, ask questions. What liquidity terms apply? What are worst-case stress assumptions? And what proportion of total assets is allocated? This shadow system is big, growing, and imperfectly understood. It doesn't have the same safeguards as the regulated banking system, and that makes it a plausible ignition point for the next major downturn. Stay informed, ask questions of your advisors, and watch the signals, because when private credit cracks, the effects could ripple into homes, jobs, and pensions. If you found this useful, subscribe for the next episode.